Hey, what's up, everybody? Matt Valencia here with Jersey Realty. I also have a partner here, Abdel Khawatmi, with Paramount Residential Mortgage Group. So just wanted to hop on here. I've been getting a lot of questions from friends, past associates who are looking to purchase, but they want to put themselves in the right position to purchase within the next year or so. So I wanted to bring Abdel in here and really get his opinion on what someone can do to prepare for the purchase today so that in the next year or so they can actually purchase the home of their dreams. So my first question to you really is, what is something that someone can do to actually improve their financials in order to really get ready to purchase in the next year or so?
So my personal recommendations, the first things that if you are mainly a millennial looking to get into the market, and I think about 38% of home buyers, which is the largest share of home buyers, are millennials. And I think a lot of clients who are slowly starting to get into the market need to take some of these recommendations and tips in mind. And the first thing is student loans. Student loans probably eliminates a good majority of the clients that I have because it's typically deferred or in forbearance. By the law with Fannie Mae and Freddie Mac, we have to usually take 1% or the client has to be in a fully amortized payment plan. I would say that is almost like 75% of the reasons why millennials usually get crushed from qualifying. And then if you do have a payment plan set up or you're not in that boat, the next recommendation that I definitely have is for you to save up for a down payment. So what runs into a lot of situations that I've seen with clients is that they save up a couple money here and there just for the down payment, but then they don't take into effect your closing costs, your inspection, your appraisal. It starts adding up. And then what starts happening is the less of a down payment that you have, the more of a less appealing offer you make to a seller as opposed to somebody who's putting 15, 20% down. Now, for everybody on here, as you're aware, or you may not be aware, when you purchase a home, you can go as low as 3.5% with the Federal Housing Administration loan with the Department of Housing. Or you can even go on a flip side with a conventional loan, which is sometimes more appealing to listing agents and sellers because there's less of a contingency on inspections, so on and so forth, than FHA. And you could put only 5% down. Now, the average closing cost you have to keep in mind on top of that is anywhere from $8,000 to $10,000, depending on the specific property, depending on the title company, attorneys, and so on and so forth that you use. And then the last thing I would definitely recommend is understand your budget. So once you've kind of had your student loans set, you've had your down payment more or less ironized, the next thing would be is to consult with a mortgage lender. So my team and I work with a lot of clients who are maybe naive to the process. And like you mentioned today, this video is not just for somebody who's looking to buy tomorrow. We deal with a lot of clients that are in the market looking to buy in 6 months, in a year, sometimes even in a year and a half. And currently, over the last really couple months, even years, it's slowly switched into a very, very competitive seller's market. And what that essentially means is that the seller kind of has the upper hand because there's a supply and demand issue right now. There's a very, very low supply and an extremely high demand of consumers. So what you can do as an educated buyer setting yourself up is make sure you have, like I said earlier, your student loan set in mind. Make sure you have your down payment correctly. The higher your down payment, as I said, the more appealing and stronger your offer is. And then understand your budget. Don't go for a $500,000 home when you're necessarily only qualified for $300,000.
Of course.
And also when it comes to self-employed borrowers, I would say probably 3/4 of self-employed borrowers don't actually know what income we use to qualify for them. So if you're a W-2 employee, we usually say gross income. If you're a 1099 self-employed income, we don't take gross. We usually have to use net income. And a lot of times self-employed borrowers who own their own business write things off. You have to take the net. So very important to consult with that or get with a mortgage lender if you are in the process of looking for a home in order to coordinate strategically, obviously compliantly, and understanding what it is that you need to deduct in order to strategically qualify.
Yeah, definitely. So for me, obviously, a lot of information that you're going to want to have to go over with the loan officer that you're working with, or during the time of getting pre-approved, right? But for just a key takeaway for this video here, what would you say are the minimums that are going to be required in terms of credit score,
Got it.
down payment, and I mean, essentially, obviously, it's all going to be predicated upon how much you can afford and all this stuff like that. But
Sure.
what's a good number that the average person watching this video can look at this and say, hey, look, I got to have this credit score and I have to have this amount of down payment to even begin a conversation with someone to say, okay, this is what I have. What can I do? What can I purchase?
Understood. So the main things that when you're looking to purchase a home is typically broken down, in my opinion, into three things. The first one is when it comes to your income, there needs to be a mandatory length of history of 2 years,
Okay.
as required by Fannie Mae. So 2 years of history. It doesn't have to be at the same employer. It more or less has to be within the same occupation. There's sometimes some little bit of a wiggle room around that, you need to be, if you're a W-2 employee where you get paid pay stubs, you need to be working as a W-2 employee getting paid pay stubs for 2 years. You cannot be a W-2 employee and then open up your own business and then try to get home.
Okay.
If you open up your own business or you're a 1099 employee, you need to wait 2 years. So the one things that we require is your tax returns. Your tax returns, generally we need the most recent 2 years when you filed. So that is one of the main requirements that I ask our clients to give us, because as I mentioned to you, people are naive, and you may not necessarily know. You're under the understanding that, oh, I just got a $20,000 raise, they can use my income. Not necessarily. We need to take the average. We're going to do what's called a verification of employment when you are under the process of purchasing a home. And then if the numbers are a little bit less than what's disclosed, you may potentially not qualify for that home, and you may have put some money, wasted your time as a realtor, and most importantly, wasted the seller's time, and you may be subject, unfortunately, to some potential legal ramifications. And then when it comes to credit scores, so credit scores is a very, very important factor when it comes to purchasing a home, as most of us are aware. The minimum requirement as of right now with an FHA loan can go as low as 580.
Okay.
But when you're going as low as 580, you are subjected to increased fees. You're subjected to what's called a manual underwriting, where Fannie Mae won't necessarily approve it. An underwriter needs to look into different factors that may potentially strengthen you. But generally, you need to have at least a 620.
Okay.
620 and over for a FHA loan will allow you to more or less still get qualified. DU, desktop underwriting through Fannie Mae, will approve you. Now, of course, anything higher than that is going to affect your rate, which I'm going to get into in 2 seconds. And then when you have a conventional loan, conventional is, so the biggest differences between the two is when you have a conventional loan, conventional is not getting insured by the bank. So FHA and conventional, they're both given by banks.
Yeah.
FHA is insured where if you do not pay, the Federal Housing Administration, through the Department of Housing, will cover the bank through their, through the missed payments. When it comes to a conventional loan, there is no security cushion for the bank. So they're going to have a little bit more stringent requirements. That's why FHA, you can go as low as 3.5. Conventional used to be 20, now it's changed to 5. So then you have mortgage insurance, of course, as most of us are aware. Mortgage insurance is forever for FHA, and then at 20% equity, you can cancel it for conventional. And then the factors that affect interest rates. So when it comes to interest rates, there's 3 main things that a consumer needs to keep in consideration, and we just went over 2 of them. The first one is the credit score. The higher your credit score, the better of a factor you are going to get for a rate, the less of a risk you are to a lender. The next thing, as we went over earlier, was your down payment. The more of a down payment you have, the more of an equity that you have in a home, the less of a risk, and the less that you're financing through the LTV. And then the last thing is the home type. So one of the most crucial things homeowners need to consider is if you're purchasing a single family home, if you're purchasing a multifamily home, and if you're purchasing a condo. Those are basically the 3, right? So if you're purchasing a single family home, that is the least riskiest type of home that you're purchasing, because chances are you're probably going to live in it if it's owner occupied. If it's not and you're an investor, you're probably going to have to put at least 25% down. But if it's going to be owner occupied, that's the least riskiest. So that's going to put you at a high totem pole for a rate. Obviously, as we mentioned with the credit score is low. you're going to get probably risk, and your interest rate's going to be slightly higher than a consumer with the same specs who's got an 800 credit score or 700 credit score. And then, so those are basically the three things that, when it comes to interest rates and the effects of what homeowners need to keep into consideration when you are slowly looking to get into it.
Yeah, and now, so just I guess recap here, right? So the target, if you're looking into an FHA style program, minimum would be about 620.
Yeah.
But ideally, you're probably going to want to target 700 because you're
Correct.
looking to purchase within the next year or so. So you should be able to achieve that.
Correct.
Now, in terms of down payment size, typically, obviously, you want your down payment amount and also closing costs to consider. But usually, $20,000 is a good target for people to start targeting for the next year and a half, right?
Yeah. So essentially, if you're looking at how I look at it, if you're looking at about a $350,000 home, 3.5 plus closing costs, you're going to need about, I would say, $19,000 to $20,000.
Yeah, about $19,000-$20,000,
so,
and that's for a single family home.
Single,
about $350,000, right?
Correct.
So that's a pretty good target, and we'll just leave that for people who are looking for that. And then essentially, also one thing: the 2 years of employment history. This is big if you're self-employed. Also, if you're just W-2 employee as well. So that's something you want to keep in mind as well. Is you have to have those 2 years. It's definitely critical. And you did say it could be different employers.
Could be different employers.
Usually, it doesn't matter if, let's say, I switch employers, but let's say the first employer I was making $50,000 a year, and now the second employer I'm making $80,000.
Great question. So
does it make a difference, or do I have to have 2 years of making $80,000?
No. So it could be different variations of income. Now, we don't necessarily automatically jump to using the $80,000 for your income. We would take essentially the average.
Okay, so the average. Okay,
so 50 and let's say 70, we would be utilizing.
And that'll help you qualify for the home that you're looking to purchase.
Correct.
Okay. All right. Well, it was a pleasure. Thank you for the time.
Absolutely.
I appreciate it. And I hope you guys got some good value out of this. And if you have any questions regarding real estate or anything related to lending as well, you can reach out to myself. I'll also tag Abdel to this video as well, so you can follow him. He has a lot of great content for us. So Thank you for your time. I appreciate it, guys.
Thanks, guys.